Which is better, investing in direct stocks or investing through mutual funds? What is the reason? Our Chief Financial Planner, Mr. Ramalingam, guide us through. Ramalingam, the screen is yours.
End of the day, we want to invest in stocks. Stocks gives you inflation beating returns. There are predominantly two avenues that can beat inflation in the market. One is real estate and the other one is stock market. Real estate got many disadvantages. Stock market, you can invest. To invest in stock market, there are five regulated avenues available in the market. One is investing through ULIP, unit linked insurance policy. Second is investing through mutual fund. Third is investing through a portfolio management service. Fourth is investing through alternative investment funds. Fifth is investing directly in stocks. All these five are regulated way of investing in stocks. ULIP, there are a lot of disadvantages due to charges, performance related issues are there. So ULIP is not a good way to invest in equity market because you can't withdraw anytime, you can't rebalance it. All those problems are there with ULIP. So ULIP as a financial planner, I will not recommend. Rest of the four avenues, yes, definitely a person should invest. A person can invest in all these four avenues. All these four are at different levels. End of the day, PMS, AAF, mutual funds, direct stocks, all are investing in stocks only. They are not going to invest in any other asset class. So it is like you have the same floor. With that, you are going to do idli, you are going to do dosa. The ingredient is same. So nutrition value is going to be same. Why should I invest through four different schemes instead of limiting myself to one particular scheme? All the four has got different unique advantages, unique disadvantages, which you have to understand. Mutual fund is basically a mass product, extremely stringently, strictly regulated product by SEBI, because a common man who's doing a 500 rupee SIP is also there in a mutual. Somebody who's doing 5 lakhs SIP is also there. Somebody who's investing 5 crore in that mutual fund scheme is also there in that portfolio. So to protect mass people's interest, there are strict regulations in mutual funds. It says as a mutual fund company, you should not invest more than X percentage in one company. In one sector, how much exposure you can have. All these things are strictly regulated. How much expense ratio to have. On what basis you have to declare NAV. So you see a lot of KYC norms are getting updated because they want to protect investors' interest. No one should do any scam and swindle money. That way, mutual fund is extremely regulated product. For a beginner to invest in stock market, mutual fund is best way to invest because of professional fund manager, diversification easily available for a 10,000 rupee investment. Because of all these reasons, mutual funds are good way to invest. Till an investor accumulates 1.5 to 2 crore money, mutual fund itself will be sufficient because it's a level 1 risk investing in equity market. Level 2 risk is investing through PMS. PMS is portfolio management service, again regulated by SEBI. There the minimum investment is 50 lakhs. Right? There is a portfolio manager who is managing our money there. Instead of investing in 20 to 30 stocks in mutual funds, in portfolio management service, the portfolio manager will be investing in something like 15 to 20 stocks. Because it's a 50 lakh product, it's not a mass product, it's a class product. SEBI knows this. So only investors with some amount of risk return analysis knowledge will come into PMS. So there is no strict regulation like how much percentage to invest in one sector, how much percentage to invest in one single stock, no restrictions. So there can be concentration. That concentration brings additional risk and additional return. That is why it is kept as level 2 risk. After you have invested a couple of crores in PMS, a person can consider to invest in AAF. AAF is third alternative investment funds, where the minimum investment is 1 crore. Again, it is regulated by SEBI. In AAF, the unique advantage is you can, there will be an alternative investment fund manager who will be investing on behalf of us in the equity market. Compared to mutual funds and PMS, the advantages, again, lesser regulation. Number two, in AAF, the fund manager has an option to invest in unlisted stocks, pre-IPO stocks, private equity. they can invest. That is another advantage of investing in AIF. This is the third level of risk. In all these first three levels, there is some manager who's managing our money. We did not have an expertise, we did not have time. These three people will be managing it. In the fourth level, which is direct equity, there, you will be opening a demat account and you will be investing on your own. So that means you should have expertise, you should also have time. One, two, three, I'm keeping direct equity as the fourth layer. Means you could have accumulated 4-5 crores in these three avenues. Then you are choosing to invest in direct stocks. Why I'm keeping direct stocks at the fourth level, not direct stocks at the first level? Because investing in direct stocks looks very glittering, to invest, because it tempts people to invest more money because it's glittering, it attracts more people. But even then, I'm keeping it only at the fourth level. Why? When there are ways to invest in stock market through mutual fund, why should I directly invest in stocks? If this question is not properly answered, then we may end up taking a lot of wrong, poor investment choices, which can help us create poor wealth. So we have to be very specific, clear. Clarity of thoughts is more important in choosing the investment vehicle. Direct stocks, I should have an expertise. Do I have an expertise like a fund manager or portfolio manager or an AF manager to choose direct stocks? No. Fund manager, there is an edge. He has a research team. In a small cap company, they can go and visit the top manager, discuss with the top manager. If it's a real estate company, he can go to the land parcels and see in the real estate company's balance sheet, these land parcels are valued at X rate. Is these land parcels can be valued at X rate? Is it worth? He can do, he can go do inspection, and based on that, he'll be able to decide, because he's investing crores of money, 500 crores, he'll be investing on a single company. So he can do that effort. Whereas as an individual investor, I don't have that sophisticated facility to go and visit or sit with the top management and understand. So I have limitations. So research is not my edge when I am investing in direct stocks. Then why should I invest in direct stocks? As a direct stock investor, what is my edge? My edge as a direct stock investor is concentration. I can have an extremely concentrated, focused portfolio of 4 to 8 stocks. Warren Buffett, Charlie Munger, they all suggest these kind of models. They will not have like a mutual fund or a PMS, they will not have 20-30 stocks. See, your mutual fund also has 30 stocks in your portfolio. You also have 30 stocks in your demat account. What is the use? It means you are running your own mutual fund in addition to having a 5 mutual funds. It's a 6th mutual fund in your portfolio. So what is the unique advantage? You don't have anything, right? So 4 to 8 stocks, extremely concentrated portfolio is what a mutual fund, PMS or AIF will not be able to do. By design, they will not be able to do. So that way, it becomes a unique advantage as a direct stock investor. It's a unique advantage for you. So when you choose why it is not possible for a mutual fund or PMS or AIF to do it, to market their product, they have to compare it with the benchmark. SEBI has given a benchmark. So every quarter, whether the fund or portfolio management service or AIF is outbidding the index is what we have to check up. So to check up that, they have to outperform the index. To outperform the index, they should have reasonable sampling from the index. Then only it is possible to outperform. If they have extremely concentrated portfolio of 4 to 8 stocks, it is not possible for them to outperform index quarter after quarter. In the long run, they will be able to do. But every quarter, will they be able to do? No. For 1 year, portfolio management service or mutual fund has not outperformed the index. Obviously, we will not select that fund. So they are under pressure to outperform every quarter. That is the problem with those kind of schemes. Whereas in direct stocks, I can choose to invest in 4 to 8 stocks. Now, the problem with 4 to 8 stocks is extreme concentration. Concentrated portfolio can bring additional return. At the same time, it also brings additional risk. Maybe when I was discussing with customers one-on-one, I have quoted this example. Right? In the year 2020, when the market crashed by 38%. That point in time, most of the stocks are available at attractive rates. ITC as a stock available at 160 rupees. That point in time. 2021 October, from Sensex from 26,000 levels in 2020, Sensex moved to 60,000 levels in October 2021. Means 100% appreciation in the index. But ITC as a stock moved up from 160 to 200. It is just a 20% return. The rest of the stocks, mid cap, small cap, during that particular phase, Adani stocks were at like a high peak. They were having huge hype about those stocks. Those stocks have given like extremely good returns. When you have a concentrated portfolio, it can perform like ITC. For 1.5 years, no returns. Will you be comfortable holding that portfolio? The market is giving you 100% return, but my portfolio has given zero return or 20% return only. So everyone in the market is like partying, but I don't have that much returns. So I don't have conviction. I'll think like, okay, I should have simply invested in mutual funds. By choosing direct stocks, I have lost. So let me go back to mutual funds, or let me over diversify into 20-30 stocks. That is the kind of mindset we'll be having. This is the problem without following level 1, level 2, level 3. When I directly invest in stocks, this is the problem we'll be having. And in 2021 to 2023 September, market was at the same 60,000 levels. Market was not giving, it was range bound, 60,000 to 50,000, 50,000 to again 60, again 50, again 60. This is the kind of range bound situation. Market has not given any return. In fact, during that time frame, most of the stocks prices have also not gone up. Even Adani stock, because of the Edinburgh report, it went down during that period. But during that range bound period, where the Sensex has not given any return, ITC stock went up from 200 to 450, 125% return. Now, 1 year, it is not giving you return. We may think to sell. The moment we sell, or the moment we over diversify into something else, that portfolio stocks perform. The point I am trying to tell you here is, when you have a concentrated portfolio, which is basically an edge as a direct stock investor, it will not work in line with index. Index may give you 100%, but your portfolio may give you 0%, 20% return. Index may give you 100% return. Index may give you no return, but your portfolio may give you 100% return. Do we have conviction and patience to stay the course and stay invested? Most of the times, no, because headlines will tempt us. This stock is making return, that stock is making return, but my portfolio is not giving you return. So when you skip level 1, level 2, level 3 and directly invest in stocks, either you over diversify and you will not get even mutual fund returns. When you have concentrated portfolio of 4 to 8 stocks, then there will be a time frame 2-3 years, your portfolio will not at all beat index, not at all beat mutual fund returns. Then we will be worried, will self-doubt, fear of missing out, will sell the portfolio. That is why I say you accumulate first 1 to 2 crores in mutual funds, then PMS, then AAF. So you have 4-5 crores portfolio. Now you take 50 lakhs to 1 crore and put it in directly. Now, even you now like you have 4 to 8 stocks direct equity portfolio that is not performing for 2-3 years, but rest of the other 3 layers will perform. When you look at your overall portfolio, you will see returns. That is why if you are an investor who have not accumulated 2 to 4 crores in mutual funds, PMS, AAF as a financial plan, we cannot have recommended direct stocks recommendations. However, it is not advisable for you to invest in direct stocks without investing in mutual funds. Accumulate enough money in mutual funds and then go to PMS, AAF and direct stocks. Hope this clarifies when to invest in direct stocks, why we are predominantly focusing on mutual funds first. It depends upon, if you are coming to us with a portfolio of 4 to 5 crores, then PMS, AAF, direct stocks, all those things can be considered. If your AUM, assets under management, what you have accumulated is less, or you are in the process of accumulating that money, then all those things also can be considered.
Thanks for your detailed answer. If you have any doubt regarding this or any other financial or investment decision, don't hesitate to book an appointment with our financial expert. The link to the appointment is given in the description below. And also, would you like to know more about finance and investment? Then we would recommend you to attend our live webinar. The link to the webinar is also given in the description below. The webinar is absolutely free. If you like this video, hit like, and if you are new to our channel, please do subscribe.